Hey everyone! With BlockSonic, you get the top Bitcoin news of the day in a practical, narrated format, so you never miss an important market move. With BlockSonic, you don't need to search for information. We find it for you. Today, the news is buzzing with the headline: Investors abandon old strategies. Bitcoin's new bold bet. Get ready for a journey through the world of cryptocurrencies where Bitcoin is revolutionizing the financial landscape. Let's uncover what's behind the new wave of optimism that's waking Wall Street up to the Bitcoin era. With an influx of $1.2 billion in Bitcoin ETFs, major investors are eyeing a golden future, abandoning old strategies and betting on a more promising market. And it doesn't stop there. The White House and Coinbase are at the center of a crypto drama, while new legislative developments promise to protect this evolving market. Stay tuned to understand how these changes could affect your portfolio and the future of cryptocurrencies. Bitcoin's billion-dollar bullish surge, a new dawn. Crypto giants pivot to long-term Bitcoin bets, ditching arbitrages. We are observing an astonishing shift in financial flows as Bitcoin exchange-traded funds, commonly known as ETFs, in the United States, have attracted a remarkable net inflow of $1.2 billion this month. This signals a seismic change in sentiment as institutional investors pivot from sophisticated arbitrage strategies towards long-term bullish stakes. The 11 spot Bitcoin ETFs in the United States have witnessed an impressive net inflow of $1.2 billion, effectively reversing the previous month's outflows, as recorded by data from Sasa Value. While this influx is undoubtedly encouraging, a deeper analysis unveils an even more profound bullish signal. Major investors are abandoning their typical arbitrage maneuvers in favor of potential long-term price increases. Previously, these savvy investors employed a strategy known as cash and carry arbitrage, a method of exploiting price discrepancies between spot and futures markets for Bitcoin. However, the current ETF inflows suggest a shift towards more straightforward bullish bets as the allure of arbitrage fades. To illustrate, consider buying a gallon of milk for $4 today, knowing you have a contract to sell it for $5 next month. In this scenario, market fluctuations are irrelevant, as the profit is already secured. In the cryptosphere, investors mirrored this by purchasing spot Bitcoin ETFs while shorting Bitcoin futures, focusing solely on the minor price differences. Yet as the gap between present and future shrinks and the costs of maintaining such trades rise, the appeal of this strategy has diminished, as the data indicates. Nonetheless, large investors are still eager to gain Bitcoin exposure, prompting a return to traditional methods, betting on the asset's long-term appreciation. Despite the significant $1.2 billion inflow into United States spot ETFs, the total number of active standard and micro Bitcoin futures contracts on the CME has surged by 33% to 55,947 contracts. This confluence of ETF inflows and increased CME open interest is typically associated with cash and carry arbitrage. However, the latest ETF inflows are likely not part of these trades, as the price gap between CME futures and spot ETFs, has tightened to levels that barely cover costs. This perspective is supported by the currently subdued front-month basis of approximately 5.5%. After accounting for expenses, the implied carry nears zero, offering minimal incentive for the trade, noted Mark Pilipchuk, a research analyst at CF Benchmarks, in a message to CoinDesk. One key factor is Bitcoin's lackluster price volatility. After plummeting from its peak in October last year, Bitcoin's price has hovered around 90,000, reducing opportunities for profitable arbitrage. Bitcoin's annualized 30-day implied volatility, as indicated by Volmex's BVV index, has declined to 40%, marking a 3-month low according to Bitfinex analysts. This shift signifies a noteworthy change in market dynamics, which is bullish for Bitcoin. Investors continue to flock to spot ETFs, as demonstrated by the $1.2 billion inflow. However, these funds are not for arbitrage. They are aimed at long-term price gains. Bitfinex analysts describe these new investors as sticky, driven by the allure of longer-term investments rather than short-term price discrepancies. The decline in volatility has made Bitcoin a safer alternative asset, appealing to institutions diversifying their portfolios. Institutional investors typically increase exposure during low volatility periods as liquidity moves down the risk curve following rallies in gold and silver. Analysts explained regarding the ETF inflows. These investors seek sticky money, not quick profits. They are committed to the market for the long term. Who are these sticky investors betting on upside rather than arbitrage? The answer lies in shorting data. In CME-listed Bitcoin futures, open interest has risen, driven by speculators pursuing bullish outcomes instead of hedging risks through shorts. Non-commercial traders are now focused on profit rather than risk mitigation, implying a heightened bullish stance. Participation from non-commercial traders capturing speculative capital has increased significantly. Open interest in CME Bitcoin futures within this group has surpassed 22,000 contracts, aligning with improved price sentiment, Pilipchuk stated. This suggests that institutional speculators, such as hedge funds, are leading the growth in open interest, seeking long-term Bitcoin price upside via regulated futures markets, rather than re-leveraging basis trades. He added that hedge funds, which typically short futures and arbitrage strategies, have steadily reduced short exposure. We at BlockSonic perceive that this shift in investor behavior highlights a growing confidence in Bitcoin's long-term prospects. As institutional investors reposition their strategies, the implications for Bitcoin and the broader crypto market are profound. What do you think about this shift towards long-term Bitcoin investments? We invite you to share your thoughts and join the conversation in the chat. Wall Street's crypto awakening. Bitcoin's next era. Cryptocurrency's future. Unleashing a financial revolution. The rhythms of digital currency are echoing with transformation as cryptocurrencies shift from niche curiosities into fundamental layers of global finance. The year 2026 might be the moment the broader market truly awakens to this reality. We at BlockSonic perceive that Fidelity Digital Assets forecast a pivotal evolution akin to the shipping container revolution in global trade. This transformation, outlined in their 2026 Look-Ahead report, draws parallels to how standardized containers reshaped ports and logistics, a seemingly mundane innovation that was decades in the making. Similarly, finance is witnessing a quiet overhaul, as highlighted by Fidelity's Vice President of Research, Chris Kuiper. The landscape of 2025 seemed unremarkable in price movements, yet Fidelity's research reveals a silent retooling of infrastructure, regulatory frameworks, and institutional strategies. Behind the scenes, regulated products, custody solutions, and institutional strategies are crafting a foundation for a breakthrough year in 2026. Kuiper emphasizes a significant cultural shift when market participants ceased declaring Bitcoin dead in 2025. This marks a symbolic acceptance, transitioning from speculative fringe to a recognized future. Digital assets tread closer to capital market integration through exchange-traded products, derivatives, and tokenization, expanding access to a wider investor base. Tokenization, the conversion of real-world assets into blockchain-based tokens, is gaining traction. Institutions are anticipated to drive this evolution, with Fidelity foreseeing synthetic exposure and structured products enhancing participation in digital asset returns, while preserving Bitcoin's traditional role as a reserve asset. Strategically, companies are expected to bolster Bitcoin reserves as conservative corporate treasuries cautiously step into the space. Behind these decisions are powerful capital allocators, pensions, endowments, and foundations, traditionally cautious entities, gradually opening up to crypto allocations. Harvard's endowment, gaining attention for its digital asset exposure, is just the beginning. A subtle yet significant trend is emerging in the advisory ecosystem. Financial advisors in the United States are increasingly able to offer Bitcoin and other digital assets to clients, overcoming previous hurdles. Wealth managers and registered investment advisors are poised to expand crypto offerings, representing a structural shift with potential impacts equating to tens of trillions of dollars. This evolution matters as advisors steadily allocate to Bitcoin and other assets, creating a consistent market demand that contrasts with earlier sentiment-driven cycles. While not instantaneous, the shift is persistent. Fidelity's research also explores emerging technological issues that may shape 2026, including quantum computing's impact on cryptographic security and the rise of quantum-ready solutions in custody and infrastructure. Blockchain layers and tokens are positioning as quantum-resistant, while custodians prepare to meet evolving security needs. On the regulatory front, ongoing United States market structure legislation may be pivotal for institutional integration. If passed, it could pave the way for traditional finance players to continue building bridges between crypto and legacy markets, potentially accelerating integration. What should markets anticipate in 2026? Coinbase suggests continued foundation building rather than fireworks. Regulatory key could accelerate momentum, allowing capital from pensions, endowments, and foundations to steadily enter the digital assets space as barriers evolve. We at BlockSonic understand that while 2025 ended flat on price, structural tailwinds from pension allocations to regulatory clarity suggest digital assets may reach new heights next year. Should Bitcoin's shipping container moment arrive, it will not be due to a sudden price surge, but because a long-prepared financial ecosystem finally aligns. Do you believe in the transformative potential of cryptocurrencies, as we at BlockSonic do? Share your thoughts and join the discussion in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the video description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Bitcoin's bill breakdown, chaos and crypto concerns. Bitcoin's future threatened, crypto bill sparks industry alarm. In the realm of digital currencies, a proposed bill targeting the regulation of cryptocurrencies like Bitcoin and decentralized finance has sent shockwaves through the industry. Major players, including Coinbase, have voiced concerns over provisions that could hinder crypto innovation and freedom. As the echoes of our collective consciousness reverberate through the Bitcoin network, we find ourselves on the brink of legislative change. Lawmakers were poised to dissect a pivotal crypto bill aimed at defining regulatory oversight by entities such as the Securities and Exchange Commission (SEC) and the Commodity Futures Trading Commission (CFTC). Yet, in a dramatic twist, Coinbase, a leading crypto exchange deeply involved in the bill's formulation, withdrew its support mere hours before the scheduled hearing, leaving the industry in disarray. This abrupt pullback led to the U.S. Senate Banking Committee canceling the hearing on the crypto market structure bill just hours before it was to commence. In the aftermath, dialogues reignited, with lawmakers and industry participants reconvening to navigate the turbulent waters of crypto regulation. The crux of the industry's concerns revolved around provisions that could stifle the launch of new tokens and decentralized projects. The bill's approach to decentralized finance, stablecoin yield, and disclosure requirements for crypto securities raised alarms. Particularly troubling were the potential constraints on tokenized securities and the SEC's expanded oversight, which could transform blockchains into permissioned products, contrary to their decentralized ethos. We perceived a lack of adequate time for the industry to scrutinize and respond to the bill's text, released with a narrow window for amendments. The bill's publication, close to midnight on Monday, allowed just 17 hours for amendments, with a hearing initially set for Thursday morning. Despite Coinbase's vocal opposition, not all industry voices were unified against the bill. Following Coinbase CEO Brian Armstrong's public dissent, other crypto entities expressed support for the hearing and the bill's framework. For decentralized finance, the bill introduced surprising provisions not present in earlier drafts, including anti-money laundering and know your customer regulations. These measures, intended to extend the Bank Secrecy Act to decentralized finance, threatened the operational freedom of blockchain projects, potentially imposing centralized compliance. We at BlockSonic interpret these developments as a critical juncture for the industry. The bill also empowered the U.S. Treasury Department to restrict how self-hosted wallets interact with exchanges, a move seen as overreaching by some. Stablecoin yield emerged as a contentious topic, with banking lobbyists securing provisions that limited digital asset platforms from offering yield rewards outside user activities, such as transactions and staking. Proposed amendments sought to tighten these restrictions further, sparking debates over the parity between banks and crypto companies regarding regulatory compliance and consumer protections. The bill also assigned the SEC authority over network tokens, defining them as securities based on the efforts of their creators. This expanded role for the SEC raised concerns about flexibility in regulating digital assets, potentially constraining the CFTC's influence. Amendments to the bill, exceeding 70 by Tuesday, included proposals from various senators. One notable amendment by Senator Angela Alsobrooks called for rulemakings and stringent anti-evasion regulations, potentially complicating compliance for firms. As we synthesize these insights, we at BlockSonic perceive a pivotal question. How can the crypto industry reconcile innovation with regulatory oversight to safeguard digital freedom? We invite you to join this dialogue and share your thoughts in the chat. Bitcoin skyrocketing potential, a 2026 vision of crypto wealth. Crypto's new era, Bitcoin's ascent and stablecoin revolution. In the ever-evolving realm of digital assets, we find ourselves on the brink of a transformative period. As we peer into 2026, seasoned crypto investor Dan Tapiero offers a striking forecast. With a $10,000 investment, consider allocating it among Bitcoin, Ethereum, and Solana in proportions that align with your outlook. Beyond individual portfolios, Tapiero identifies monumental opportunities within the crypto ecosystem, particularly as its infrastructure integrates into the mainstream. Stablecoins, for instance, are revolutionizing global transactions, with volumes projected to soar to $33 trillion by 2025, a significant leap from $19.7 trillion in 2024. There's a whole ecosystem evolving as traditional entities strive to incorporate stablecoin frameworks into their operations. Tapiero, the founder of the prominent growth equity firm 50T Funds, observes. Bitcoin remains a pillar of his strategy, both as a robust investment and a macroeconomic safeguard. He anticipates it reaching $180,000 in the current cycle, driven by demand growth and global monetary transformations. This is merely a market correction. The foundation is set, he asserts, in light of recent downturns. Tapiero envisions favorable conditions from declining interest rates and extensive spending on artificial intelligence infrastructure. This global momentum is causing currency devaluation, affecting not just the United States dollar, but fiat currencies globally. That scenario bodes well for Bitcoin, he notes. While he acknowledges promising developments in tokenization, blockchain artificial intelligence convergence, and on-chain prediction markets, Tapiro remains skeptical of trends like crypto treasury companies, which he perceives as lacking substantial innovation. There's no protective barrier, he remarks. The long-term value proposition for 95% of them is unclear. His ultimate insight, even by 2026, the crypto landscape remains in its infancy, yet it is maturing rapidly, increasingly driven by practical applications rather than mere speculation. The rapid growth of stablecoins, payments, and financial sectors stems from their immediate focus on monetary aspects. Tapiro concludes, "We at BlockSonic perceive that these insights illuminate the dynamic and unpredictable nature of the crypto world. How do you, as part of this vibrant community, interpret Tapiro's vision for the future of cryptocurrency? We invite you to share your thoughts and engage in this ongoing conversation in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat." The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. White House crypto drama. Coinbase strikes back. Coinbase CEO Brian Armstrong denies White House crypto conflict. We at BlockSonic have observed the recent buzz around Coinbase and the White House, where rumors suggested that the administration might withdraw its support for the crypto market structure bill. However, Brian Armstrong, the CEO of Coinbase, has clarified that the White House has been notably constructive in their approach. In a recent social media update, Armstrong shared that the White House encouraged Coinbase to work on a deal with the banks, a task currently in progress. This rumor mill was stirred by Eleanor Terrett, a journalist and co-host of the Crypto in America podcast, who claimed that a source close to the administration suggested a potential withdrawal of support if Coinbase failed to negotiate a satisfactory yield agreement with the banks. Armstrong's rebuttal emphasized that their talks with the administration are ongoing, focusing on integrating community banks into the digital asset dialogue, a sector often overlooked. He mentioned that Coinbase is actively developing ideas to aid community banks through this bill, underscoring the importance of these institutions in the broader crypto conversation. The tensions between banks and the crypto world escalated after Coinbase, a leading crypto exchange deeply invested in the crypto market structure bill, unexpectedly withdrew its support last week. This move threw the industry into turmoil, triggering debates on whether banks aim to stifle the bill to limit their competition. Following Coinbase's public withdrawal, the United States Senate postponed a scheduled hearing on the bill less than 12 hours before it was set to commence. Armstrong's latest comments imply that, from Coinbase's viewpoint, lawmakers are not obstructing progress. Rather, they might be seeking collaboration between the crypto and banking sectors. We at BlockSonic interpret these developments as indicative of a complex dance between innovation and tradition, with both sectors navigating their coexistence in the financial ecosystem. How do you perceive the evolving dynamic between crypto innovators and traditional banks? Share your thoughts with us and join the conversation in the chat. Bitcoin, the future of diversified portfolios. Bitcoin's role in revolutionizing risk management in investments. As we delve into the rhythmic flow of decentralized assets, we see a narrative emerging. Bitcoin is carving a new path in portfolio diversification. ARK Invest's Kathy Wood opens a window into how cryptocurrencies, particularly Bitcoin, could reshape the landscape of institutional investment strategies. Her foresight hinges on Bitcoin's unique position. Its distinct lack of correlation with traditional asset classes like stocks, bonds, and gold, promising a revolution in risk-adjusted returns. In the expansive digital frontier, Bitcoin emerges as a beacon for asset allocators. Cathie Wood's insights highlight Bitcoin's potential as a diversification instrument. Her analysis emphasizes Bitcoin's low correlation with equities, bonds, and even gold, paving the way for strategic asset allocation. This decentralized asset, she suggests, could serve as a cornerstone for those seeking enhanced returns per unit of risk. Since the pivotal year of 2020, Bitcoin's correlation with traditional assets has remained strikingly low, as depicted by ARK's data. For example, Bitcoin's correlation with the S&P 500 index stands at 0.28, a stark contrast to the 0.79 correlation between the S&P 500 and real estate investment trusts. We at BlockSonic understand that this dynamic positions Bitcoin as a compelling choice for those navigating the intricate dance of risk management in large institutional portfolios. Cathie Wood's bullish stance on Bitcoin comes at a time of contrasting views, such as those from Jefferies strategist Christopher Wood, who recently reversed his Bitcoin recommendation, favoring gold due to potential advancements in quantum computing. Despite this divergence, we at BlockSonic perceive a broader trend. Other financial giants like Morgan Stanley and Bank of America are increasingly recognizing Bitcoin's value, advocating for strategic allocations. CF Benchmarks further supports this narrative, advocating for Bitcoin as a portfolio staple that enhances efficiency through improved returns and diversification. Meanwhile, Brazil's Itaú Asset Management echoes this sentiment, suggesting a modest allocation to Bitcoin as a hedge against foreign exchange and market volatility. We at BlockSonic assimilate that these signals from varied financial landscapes underscore Bitcoin's evolving role. Are we witnessing the dawn of a new era where Bitcoin becomes an indispensable part of diversified portfolios? We invite you to share your thoughts and join the conversation in the chat below. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Liquidity crunch in crypto, a stark warning for Bitcoin believers. Crypto's next phase hinges on liquidity, not hype, warns RO's Jason Atkins. In the ever-evolving realm of cryptocurrencies, we've seen a year dominated by chatter of institutional interest. Yet a persistent shadow looms: insufficient liquidity to welcome Wall Street's grandeur without unsettling the delicate balance of prices. As we approach Consensus Hong Kong, Jason Atkins, the Chief Commercial Officer at Oros, a crypto market maker, emphasizes that the Achilles heel of our industry isn't volatility, but the deep-rooted issue of illiquidity. You can't just invite institutional capital without providing a proper entryway, Atkins asserts. The crux of the matter is whether our markets can endure the magnitude of institutional cravings. It's easy to say, we've lured them in, Atkins elaborates. But do we have enough space to accommodate them? Atkins explains that our markets are not devoid of interest, rather significant deleveraging events, such as the October 10th plunge, have expelled traders and leverage faster than they can rebound. Liquidity providers react to demand instead of creating it, leading to diminished trading activity and prompting market makers to retreat from risks. This thinning of market depth then spirals into heightened volatility, which triggers stricter risk controls and further liquidity withdrawal. Institutions, Atkins argues, cannot act as stabilizers when markets are this thin, leaving a void when stress arises. This creates a vicious cycle where illiquidity, volatility, and caution reinforce each other, keeping markets fragile despite enduring long-term. interest. Volatility itself, Atkins notes, does not deter large investors. The true challenge arises when volatility meets thin markets. Managing volatility is arduous in illiquid markets, Atkins comments, as positions become difficult to hedge and even more challenging to exit. This scenario holds more significance for institutions than retail traders. Large investors adhere to strict capital preservation mandates, leaving little room for liquidity risk. When handling substantial funds or operating as a major institutional player, Atkins states, the focus is not on maximizing yield alone, but on maximizing yield relative to capital preservation. Atkins also counters the notion that capital is merely shifting from crypto to artificial intelligence, clarifying that both sectors are at different stages in their cycles. While artificial intelligence has been around for years, its recent surge in attention has not caused capital flows to crypto to dwindle. Conversely, crypto has matured into a phase of consolidation rather than novelty. I believe the industry is experiencing consolidation, Atkins observes, adding, there isn't much financial innovation occurring. Many of crypto's foundational elements, such as Uniswap and automated market makers, are no longer novel. The AM model isn't new, he notes. The slowdown in crypto liquidity is more about the lack of new frameworks to attract sustained engagement than about funds being diverted elsewhere. According to Atkins, crypto is experiencing its LM moment. In his view, the liquidity issue is structural, not cyclical, nor is it about new risk assets siphoning capital from others. Until markets can absorb size, manage risk, and exit gracefully, fresh capital will remain wary. Interest may persist, Atkins concludes, but liquidity, not narrative, will determine when it can be realized. We at BlockSonic understand that liquidity stands as a critical gatekeeper for cryptocurrency's future evolution. Could the lack of liquidity truly be the barrier that holds crypto back from its next leap forward? Join the conversation and share your thoughts with us in the chat. Crypto platform surges with $2 billion volume amid Bitcoin airdrop buzz. Cryptocurrency enthusiasts are diving into a trading frenzy, spurred by whispers of a Bitcoin airdrop in 2026 and a hefty investment boost from Easy Labs. We, at BlockSonic, explore the remarkable rise of Genius Terminal, a cryptocurrency trading platform powered by Easy Labs, formerly Binance Labs, with guidance from Changpeng CT Zhao, Bonanza's co-founder. This platform is experiencing a meteoric rise in anticipation of a much-talked-about airdrop. Recently, the platform hit an unprecedented single-day trading volume of $787 million, as reported by Dune Analytics. A considerable chunk, approximately $728 million, originated from Ethereum virtual machine-compatible platforms. These are decentralized virtual environments executing smart contracts. Now, the platform's weekly trading volume has soared past $2 billion, a stark contrast to the $85 million just a week earlier. The average trading volume per user wallet skyrocketed to $82,400, showing a significant surge in user activity. This growth isn't purely organic. Traders are flocking to Genius Terminal, fueled by expectations of an impending airdrop, a method where crypto ventures reward early adopters with tokens for engaging with their new applications. This has ignited a trading storm on Genius Terminal, with users eager to earn tokens based on their trading activity, a strategy known as airdrop farming. Airdrop farming is a widespread trend among cryptocurrency users, allowing them to engage in nascent projects and secure tokens before they hit exchanges. Subsequently, traders sell these early tokens on open exchanges if prices climb, capitalizing on their airdrop farming endeavors. Yet, token price hikes are not always guaranteed. This is reminiscent of electric vehicle maker Rivian's approach during its IPO, where pre-ordering customers received shares at the IPO price, enabling potential profits when shares began trading openly. Yet, Genius Terminal has not set a date for the airdrop. What they have done is allude to such rewards through social media teasers, mentioning parachutes, airdrops in 2026, and hints of something big linked to their point system, Genius Points, GP. The platform's points program, currently devoid of tokens, is in its initial season and rounds rewards based on trading, transactions, and referrals. The concept is simple. The more a user trades, the more points they accumulate, with escalating bonuses from smart to God status. The team suggests GP could grant access to future benefits, including possible token airdrops. Genius Terminal has also unveiled an airdrop page, hinting at a token drop this year. The initiative is backed by a substantial multi-eight-figure investment from Yeezy Labs, with GD as an advisor. We at BlockSonic perceive that the intersection of anticipation and strategic investment is driving this surge in trading activity. Could this trend redefine how new platforms approach growth and user engagement? We invite you to share your insights and join the discussion in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us! These simple actions really help the project grow and keep BlockSonic running at full speed every day. Crypto revolution. Tokenized assets poised for a $400 billion surge. Crypto insiders predict a monumental shift as tokenized assets surge to $400 billion by 2026, transforming the financial landscape for Bitcoin and beyond. In the realm of digital currencies, stablecoins emerged as a bridge to mainstream in 2025, setting the stage for a new era where traditional equities, money market funds, and even gold are poised to become tokenized. Tradable entities on blockchain networks don't. The journey from proof of concept to widespread adoption is well underway, with financial giants such as BlackRock and J. Morgan deeply involved. The tokenized asset market grew nearly fourfold in 2025, reaching close to $20 billion, as per ERIXUZ data. This trajectory hints at substantial growth but also underscores the need for legal clarity and interoperability to prevent market fragmentation. We at BlockSonic understand that the shift towards tokenization is not merely a trend, but a fundamental transformation in how value is transferred. As stablecoins have demonstrated their utility, the next phase involves a profound restructuring of financial systems, driven by demand and capital flow. As fiat currencies become tokenized, the natural progression leads to investment assets, creating a seamless bridge between digital money and digital capital market. However, foundational work remains essential, including legal frameworks and shared identity systems, to scale these tokenized markets effectively. As we at BlockSonic interpret, the question is no longer about if finance will move on-chain, but rather how extensively and swiftly it will happen. With banks transitioning from experimentation to full implementation, tokenization is edging closer to becoming a mainstream tool for raising capital. This evolution is particularly pronounced in emerging markets, where local issuers bypass legacy systems, offering global investors access to new capital markets at reduced costs. The momentum is evident with predictions that the total value locked in real-world asset tokens could exceed $100 billion by the end of 2026. Major asset managers are expected to launch on-chain versions of their products, transforming the landscape of index providers and tokenized equities. We, at BlockSonic, learned that the barriers to tokenized equities are diminishing. with credible structures emerging that allow public equities to transition from being off-limits to in play. This shift is supported by trading platforms offering token versions of popular stocks, and the movement towards direct issuance is gaining traction. As tokenized exchange-traded funds gain popularity, users holding stablecoins will seek exposure to the United States markets, making tokenized indices a logical next step. Real-world assets will increasingly serve as collateral within decentralized finance, aligning high-quality collateral with institutional adoption. We at BlockSonic perceive that the true challenge lies in the infrastructure layer. Tokenized securities will not be confined to a single ledger, but will span multiple chains and platforms, necessitating seamless movement across systems to avoid fragmentation. As tokenization becomes a new form of globalization for financial assets, facilitating dynamic collateral, flows, and cross-border participation, we observe that gold is becoming a pivotal asset class. With its rising value and growing interest in tokenized gold, 2026 could mark a breakthrough year. The convergence of rate, volatility, geopolitical fragmentation, and declining trust in sovereign debt is driving the shift towards gold-backed assets as the collateral layer for on-chain finance. We at BlockSonic assimilate that programmable gold will evolve from a niche category into the default standard for hard assets in on-chain finance. With these developments, we ask, how do you envision the impact of tokenized assets on the future of decentralized finance? Share your thoughts and join the discussion in the chat. Stake and Shake's Bitcoin Bonanza, a $10 million crypto investment. Stake and Shake embraces Bitcoin, creating a cycle where crypto revenue fuels growth and innovation. This week, we at BlockSonic witnessed Stake and Shake, a beloved fast food chain, infuse its corporate treasury with $10 million worth of Bitcoin. This move amplifies their crypto embrace, following 8 months of accepting Bitcoin at all United States locations. The chain revealed on social media that this decision is part of a self-reinforcing cycle. Customers pay with Bitcoin, boosting sales, and all crypto revenue feeds into their SR $0.03744 fund. This fund supports enhancements from premium ingredients to restaurant renovations, without increasing menu prices. 8 months ago, Stake and Shake embarked on a burger to Bitcoin journey, accepting Bitcoin payments the company shared. Since then, our same-store sales have surged significantly. In May last year, Stake and Shake began Bitcoin acceptance via the Lightning Network to slash card processing fees and attract a younger, crypto-savvy clientele. The company reported a more than 10% rise in same-store sales in the second quarter of 2025. Chief Operating Officer Dan Edwards highlighted a 50% savings in processing fees when customers choose Bitcoin payments. Last October, Stake and Shake introduced a Bitcoin-themed burger and started donating a portion of each Bitcoin meal to open-source Bitcoin development. This latest $10 million acquisition, approximately 105 Bitcoin at current rates, marks the chain's boldest treasury investment yet. While this amount is modest compared to larger corporate Bitcoin treasuries, such as Strategy's 687,410 Bitcoin worth over $65 billion, it underscores continuous corporate adoption. Bitcoin held in treasuries, spanning from autonomous entities to exchange-traded funds, now exceeds 4 million, according to Bitcoin treasuries. Data. We at BlockSonic understand that Stake and Shake's strategic alignment with Bitcoin could signal broader trends in corporate treasury management. What are your thoughts on this crypto-driven revolution in the fast food industry? Join the conversation and share your perspective in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. The image in this live stream is a real-time game. We're implementing new features where you can interact with the game using commands via chat. Join us. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Crypto bill shakeup. The big reveal? Bitcoin's future hangs in balance as Senate delays crucial bill vote. The crypto landscape witnessed a whirlwind this week as the much-anticipated crypto market structure bill faced an unexpected delay. Pulled from the Senate Banking Committee's schedule mere hours before a crucial vote, the bill remains alive but faces an uncertain path. Proponents of the bill find themselves in challenging waters, with potential progress in the coming weeks. Hints of turbulence surfaced early on. By Tuesday, concerns loomed large, with whispers suggesting the bill's dire state. Within 2 days, Senator Tim Scott, head of the Senate Banking Committee, announced a postponement of the markup hearing. While the bill endures, the path forward is fraught with difficulty. The markup hearing marks a significant hurdle, yet it's not insurmountable. Remember, the Genius Act, focused on stablecoins, faced public setbacks yet emerged victorious last summer. Contention shadows the legislative journey. Banking committee members grapple with stablecoin, yield provisions, and ethical considerations surrounding presidential crypto ties. A bipartisan team's letter highlights further friction, pointing to provisions for software developers and their legal safeguards. The crypto sector voices its concerns, from Securities and Exchange Commission Authority to decentralized finance regulations. Ron Hammond of Wintermute suggests potential alignment among key players, though senator-specific conflicts persist. Nevertheless, the bill maintains momentum amidst domestic and geopolitical shifts. The Senate Agriculture Committee, poised to release its own draft, could influence the bill's trajectory. With agriculture potentially leading the charge, it might prompt the Banking Committee to act, regardless of the bill's current state. The Banking Committee appears to be refining the draft, with Democrats engaging industry leaders to reignite dialogue. The watch list includes upcoming negotiations and possible compromises on key issues. As stakeholders remain engaged, the likelihood of another markup looms. We at BlockSonic understand that the crypto market's pulse is intricately linked to legislative shifts, and we at BlockSonic perceive that the unfolding events will deeply influence the crypto realm's future. As we stand at this crossroads, we ask, how do you envision these legislative shifts shaping the future of Bitcoin and the broader crypto landscape? Share your thoughts and join the conversation in the chat. Bitcoin's lone wolves strike gold, a fortunate week for solo miners. 2 independent Bitcoin miners hit the jackpot, each claiming a full block reward worth approximately $300,000, defying the dominance of large mining pools. In a remarkable turn of events, 2 solo Bitcoin miners independently mined full blocks, each securing a reward of around $300,000 this week. This occurrence serves as a powerful reminder that even small operators can find their fortune amidst the pool-dominated landscape of Bitcoin mining. On an early Thursday morning, one miner successfully mined a block, earning a payout of 3.157 Bitcoin, inclusive of transaction fees. Earlier in the week, another solo miner achieved a similar triumph, with their reward estimated near $295,000, based on publicly available block data and mempool trackers. Such outcomes are rare in a network where most miners join forces in large pools. These pools, like Foundry USA, NatPool, and F2Pool, dominate the scene by combining computational power to improve block finding chances. In contrast, solo miners face daunting odds but are rewarded with the full block subsidy and fees when they succeed. Mempool data highlights that the vast majority of blocks are produced by a select few pools, leaving limited opportunities for smaller operators to claim blocks consistently. Bitcoin mining remains a game of probabilities where increased computing power enhances chances, yet offers no guarantee of capturing the next block. These consecutive solo victories come at a time when United States mining dominance is showing signs of waning. Some publicly listed miners have redirected their resources towards artificial intelligence and high-performance computing, while other regions, including China-linked pools, have regained footing, as noted in recent industry reports. We at BlockSonic understand that these extraordinary solo wins underscore the unpredictable nature of Bitcoin mining. The narrative of a hobbyist miner scoring a full block with an older machine, as reported last November, further illustrates the rarity and intrigue of such events as the network's hash rate continues to climb. What does this mean for the future of solo mining in a landscape increasingly controlled by large pools? We invite you to share your thoughts and join the conversation in the chat. Crypto protections, a new frontier for market legislation? Crypto legislation. Senate committees clash over developer protections. In an intriguing twist, the legislative landscape for crypto developers is stirring conversations through the corridors of power. The Blockchain Regulatory Certainty Act, a focal point of debate, finds itself at the heart of discussions on how crypto market structure legislation should evolve. We at BlockSonic perceive that this reflects a broader tension between innovation and regulation within the digital asset sphere. The Senate Judiciary Committee, led by Senators Chuck Grassley and Dick Durbin, expressed concerns in a letter to the Senate Banking Committee. They highlighted that Section 6.4 of the Market Structure Bill might inadvertently weaken federal laws around unlicensed money transmitter businesses. This section, intended to offer legal protection to software developers against liability from third-party misuse, has sparked contentious debates. The letter referenced the Department of Justice's case against Tornado Cash developer Roman Storm, underscoring the importance of existing statutes in prosecuting unlicensed money transmitting activities. This development adds another layer of complexity to the Market Structure Bill, initially set for debate and vote by the Senate Banking Committee, but postponed amid rising opposition. Notably, Senators Cynthia Lummis and Ron Wyden introduced the Blockchain Regulatory Certainty Act as a standalone bill, possibly indicating its exclusion from the broader market legislation. This scenario suggests that the Judiciary Committee, which oversees legal matters, might need to weigh in, shaping the bill's final form. Decentralized finance advocates have voiced that excluding these protections could jeopardize their support, hinting at a potential deadlock. The letter concluded with a call to reject language that might weaken accountability for unlicensed money transmitting businesses. We at BlockSonic interpret this as a pivotal moment in crypto legislation, reflecting the challenges of balancing innovation with regulatory oversight. Will the push for developer protections reshape the future of crypto regulation? We invite you to share your thoughts and join the conversation in the chat. 8th Street's bold blockchain-based, revolutionizing finance with crypto. State's $36.0 billion leap. Bridging traditional finance with blockchain's future. State Street, with a market cap of $36 billion, is leading a transformation, bridging the gap between legacy finance and the digital future. This shift isn't about Bitcoin, but about leveraging blockchain to redefine traditional assets. The bank has launched its digital asset platform, offering infrastructure for tokenized money market funds, exchange-traded funds, cash products, and stablecoins. With capabilities spanning public and permissioned blockchains, the platform includes wallet management, custodial services, and digital cash. Chief Executive Officer Ronald O'Hanley emphasized that the shift to digitalization centers on enhancing traditional financial assets efficiency through blockchain rather than focusing on cryptocurrencies like Bitcoin. New Street positions itself as the bridge between these financial worlds. Tokenization of money market funds is a crucial application in this new financial landscape, providing collateral, faster settlement, and a digital operating model bridge. State Street is not alone. Major banks like J.P. Morgan and Goldman Sachs are also pursuing blockchain innovations. J.P. Morgan's JPM Coin and Onyx Network, Goldman's digital asset platform, and Citi's tokenized services signify a systemic shift. These developments lay the foundation for a future where traditional assets transition smoothly over blockchain rails. Simultaneously, State Street is preparing for new financial market scenarios, such as settling securities with stablecoins, enhancing its digital capabilities. The bank's investment in and partnership with Apex Fintech Solutions aims to expand its wealth services market reach, catering to clients seeking digital assets. O'Hanley noted that the financial impact of these initiatives will take time to materialize, possibly not until 2026. However, current investments ensure State Street remains relevant in the evolving financial landscape. The focus is on transforming infrastructure, not speculation, enabling institutions to transition from traditional to digital finance efficiently. We at BlockSonic perceive that State Street's strategic moves are significant in the evolution of finance, emphasizing infrastructure over speculation. How do you see the role of blockchain in transforming traditional finance into a digital powerhouse? Share your thoughts and join the conversation in the chat. Cryptocurrency chaos. Massive theft shakes Bitcoin and Litecoin. A breathtaking breach has rocked the crypto world as a cunning social engineering attack results in a loss exceeding $282 million in Bitcoin and Litecoin, rapidly funneled through Monero's cloak of anonymity. A sophisticated hacker has executed a bold theft, capturing an astounding $282 million worth of Litecoin and Bitcoin through a deceptive social engineering scheme involving hardware wallets. As revealed by blockchain analyst Zach in this daring heist, the victim was stripped of approximately 2,050,000 Litecoin and 1,459 Bitcoin, with the stolen assets swiftly converted into the privacy-focused cryptocurrency Monero, valued at $591.56 via multiple instant exchanges. Furthermore, a segment of the Bitcoin was seamlessly bridged to Ethereum, Ripple, and Litecoin, using Thorchain. As Zach Speed elucidates, emphasizing that North Korean hackers were not implicated in this incident. The audacious hack unfolded on January 10th at 11 o'clock post, Meridian Coordinated Universal Time, triggering a dramatic 70% surge in Monero's price over the subsequent 4 days. The identity of the victim remains shrouded in mystery, leaving us uncertain if it was an individual crypto holder or a corporation. Yet it aligns with a 2025 trend highlighting social engineering as the primary attack vector for cybercriminals. Such attacks typically involve masquerading as a company employee to gain a victim's trust, ultimately coaxing them into divulging sensitive data like private keys or login credentials. Additionally, on January 5th, the hardware wallet provider Ledger suffered a data leak resulting from unauthorized access to users' personal information, including names and contact details. We at BlockSonic perceive that this incident underscores the vulnerabilities inherent in the digital asset landscape and the critical need for robust security measures. How do you see the future of cryptocurrency security evolving in response to such challenges? Share your thoughts and join the conversation in the chat. Crypto bill reboot. Senate's bold move to reshape Bitcoin's future. Senate Democrats reignited discussions to redefine the crypto landscape, aiming to push forward with a transformative bill amidst industry anticipation. United States Senate Democrats have reignited negotiations over a pivotal crypto market structure bill, sparking discussions with representatives from the crypto industry during an Engaged Friday call. As insiders reveal, the legislative landscape saw a sudden delay with this week's high-profile setback, yet Democrats expressed their readiness to advance the bill. Participants in the call sensed that the Senate Agriculture Committee remains committed to an end-of-month target for a markup hearing, despite the industry's request for confidentiality regarding specific detail. Democrats from the crucial Senate Banking Committee and the Agriculture Committee joined the conversation, following the initial hearing scheduled for Thursday. This week's draft legislation faced significant criticism, with United States crypto exchange Coinbase opposing the current version. Senate Banking Committee Chairman Tim Scott has yet to announce a new date for a markup hearing, where lawmakers will consider amendments and potentially advance the bill to the Senate floor. Meanwhile, the Agriculture Panel's markup remains set for January 27th, although insiders speculate on potential delays. Should both committees approve their respective bills, the banking version focusing on the Securities and Exchange Commission and the agriculture one on the Commodity Futures Trading Commission, these would merge into a unified bill for a Senate vote. Assuming no further disruptions from federal spending debates at month's end, the legislative path remains clear. However, as the calendar edges toward the August recess, Senate floor capacity tightens. The midterm congressional elections further complicate bipartisan efforts, diverting members to campaign commitments. The crypto bill stands as a rare bipartisan venture, symbolizing an oasis amidst political turbulence, with both parties keen to negotiate a viable outcome. We at BlockSonic understand that this cooperative spirit could lead to significant shifts in the crypto domain, impacting how Bitcoin and other digital assets are governed. What do you think about this renewed legislative push and its potential impact on the crypto space? We invite you to share your thoughts and join the conversation in the chat. Bitcoin's shocking slide amid market turmoil. Crypto's dramatic turn. Bitcoin dips as markets falter. We at BlockSonic witness the echoes of market fluctuations as Bitcoin, valued at $95,164.15, continues its retreat. This descent, initiated the previous day, has seen Bitcoin relinquish a significant portion of its early week gains. In the mid-morning pulse of the United States markets on Friday, Bitcoin was trading at $94,300, marking a further decline of 1.3% over the past 24 hours after a similar fall on Thursday. Ethereum's Ether, priced at $3,332.77, mirrored this trend, sliding to $3,200. The CoinDesk 20 index, representing a broad market, retreated by 1.5% during the same interval, with XRP, Aptos, and Polygon experiencing drops of 3 to 6%. Bitcoin's recent breach of the $90,000 threshold, soaring to nearly $98,000 earlier in the week, had invigorated bullish sentiments. Enthusiasts speculated that those betting on stagnant or declining prices might reverse their positions, potentially propelling Bitcoin beyond the $100,000 mark. However, contrary to these expectations, Bitcoin now seems poised to revisit the lower bounds of $90,000. Today's downturn coincided with declines in gold and silver, which had also seen substantial rallies earlier in the week, falling by 1.2% and 5%, respectively. Major United States stock indexes, including the Nasdaq, S&P 500, and Dow Jones Industrial Average, reversed from initial gains to modest losses in Friday's trading session. Yet, crypto miners defied this broad market downturn, buoyed by investor optimism surrounding the development of artificial intelligence infrastructure. Riot surged by over 10% following a leasing agreement with chipmaker Advanced Micro Devices, while CleanSpark, Cipher Mining, Galaxy, and Iron followed suit with gains of 5 to 8%. We at BlockSonic understand that these intertwined market movements reflect the broader economic landscape and its influence on crypto assets. How do you interpret these dynamics affecting Bitcoin's journey? Share your thoughts and join the conversation in the chat. Crypto card surge. $19 billion boom in Bitcoin payments. Crypto cards revolutionize everyday transactions with Bitcoin, new data reveals. We have witnessed a quiet yet significant shift towards crypto spending, where digital cards enable users to spend stablecoins and Bitcoin at traditional retailers. This emerging trend is rapidly becoming a cornerstone in the digital payment landscape, challenging the established peer-to-peer transfer methods. Artemis research highlights this evolution. Crypto card transactions soared from around $100 million in early 2023 to over $1.5 billion by the close of 2025, marking a remarkable 106% annual growth rate. This market now boasts an annualized volume exceeding $18 billion, closely rivaling peer-to-peer stablecoin transfers valued at $19 billion, which saw a modest 5% growth within the same time frame. While the interest in direct stablecoin merchant acceptance continues to rise, cards remain the preferred medium for stablecoin expenditure due to their seamless integration with existing merchant systems. Visa's stablecoin-linked card transactions reached a $3.5 billion annualized run rate by the fourth quarter of 2025, accounting for roughly 19% of the total crypto card transactions. The report authors noted, in nearly all markets, USD takes precedence in stablecoin volume. However, two countries present unique cases. India, where USDC captures 47.4%, and Argentina with 46.6% USDC usage, setting them apart as global outliers. They further observed India's emergence as the leading crypto market in Asia-Pacific by inflows, with $338 billion United States dollars over 12 months, ending June 2025. Reflecting a 4,800% growth over 5 years. The crypto card ecosystem largely mirrors traditional Visa and MasterCard networks, with Visa capturing over 90% of on-chain card volume, thanks to early collaborations with crypto-native infrastructure providers. We at BlockSonic understand that these developments signal a significant transformation in how cryptocurrencies are integrated into everyday transactions. How do you foresee this evolution in crypto payments shaping the future of digital finance? Share your thoughts and join the conversation in the chat. Thank you so much for following BlockSonic today. See you in the next live session with more news, analysis, and market alerts. Don't forget to follow our channel and turn on notifications. See you soon. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.